Most investors think bond funds are safe, but hidden inside are extra fees, more risk, and no set maturity. What if your income strategy could be predictable, transparent, and built to adjust with interest rates? At Puzzle Wealth Solutions, we made a very intentional decision not to use bond funds at all. I'm David Millington, certified financial planner professional and president of Puzzle Wealth Solutions. I've spent over 2 decades helping individuals and families build personalized financial strategies that seek to grow and preserve their wealth. If you're new here, I've been named a multi-year Forbes Best in State Wealth Advisor, and I'm currently ranked number 124 in the United States by Advisor Hub for advisors managing over $1 billion. Let's go through some of the reasons why. Reason 1, why we don't use bond funds. Bond funds add an extra layer of management fees. On top of the bond holdings themselves, those fees quietly eat into returns. Bond funds also have no set maturity. You don't know exactly when or how much principal comes back. And because bonds are constantly traded in and out, bond funds are far more sensitive to interest rate swings. So that adds unnecessary risk and volatility to your fixed income portfolio. Reason 2, the value of laddered individual bonds. With a bond ladder, we purchase individual bonds with staggered maturity dates, 1, 2, 3, 4, 5, 10 years out. Each year, a portion matures, returning principal that can be reinvested at current rates or used for expenses. This structure creates flexibility. If rates rise, new money goes in at higher yields. And if rates fall, those longer term holdings keep paying higher locked-in income. It's about balancing predictability with adaptability. Right now, most of our ladders lean shorter in maturity. Why? Shorter bonds are less impacted by interest rate changes. They also give us more flexibility. At the same time, we do hold some longer maturities. So if rates decline, those bonds continue paying higher locked-in yields. Isn't it better to have both stability and opportunity in your portfolio? Our trading desk in action. We have a trading desk that constantly monitors the bond market. They execute purchases on behalf of our clients. So when a bond matures, we look to reinvest it promptly. That way money is not left idle. But if we know you have upcoming cash needs, we can leave proceeds more liquid for you. That way you always have the right balance between reinvestment and accessibility. And for retirees, that balance can be the difference between worry and confidence. For retirees, we often automate monthly payouts directly to their bank accounts. Feels just like a paycheck that you once earned from a job. Most excess cash works in higher yielding money markets until it's needed. And when bigger expenses come up, like remodeling a home, travel, or even buying a second house, our 6-person operations team make sure access to your funds is seamless. So retirement is easier when income feels predictable and liquidity from our bond ladders feels effortless. So while many investors default to bond funds, at Puzzle Wealth Solutions, we've chosen a different path that usually takes more work, but is usually worth it. Individual bonds laddered with intention, managed by our trading desk, and integrated into your overall financial plan can provide greater transparency, greater control, and greater efficiency. If you'd like to learn how this approach could work in your portfolio, click the link to schedule a Zoom meeting with our team. And if you found this video helpful, please like that video and subscribe for more insights. Until next time, stay informed, stay proactive, and take control of your retirement.